I want to move on because there's an interesting note here, Daniel, from Mike Wilson. Mike Wilson's the guy from Morgan Stanley. He is the person that told everyone that the market was going to crash, and he was been very bearish even in December. He said we could see a market rally, but it caught him off sides as well as a lot of other people off sides. And he put out a note, and it was weird because he put this out on Sunday. The markets closed Monday, so everyone was talking about it yesterday, and I think this helped contribute to the market coming down. We have that note, right? And he said he's comparing the current market to the death zone on Mount Everest. So that's the altitude which oxygen pressure is insufficient to sustain human life for an extended period, right? So he's comparing that, he's using that term, the death zone for the markets. He's referring to the equities or the earnings risk premium, the ERP, okay, which is the excess return from equities over the risk-free rate. So the risk-free rate is, you use 6-month T-bills is over 5%. So if you say in the past, you expect to earn 8% on stocks annually, right? On average, that's usually the percentage goes up pre-COVID. For the past 50 years, on average, around 8%. If the risk-free rate was 2%, so say 6 months was at 2%, just say, then the equity risk premium is at 6%, which is pretty good. The lower that number goes, the worse it is, right? Meaning you're taking more risk. And it's important that you understand this because I might not be explaining it well, but I'm going to try. On the average since 2008, it's around 4 to 5%, right? Which is pretty good, right? So if you're buying equities, you're assuming 4 or 5% over, something that you would get for free, an interest rate that you would get for free. That's what it's usually been. In fact, since 2008, it's hit 3% a few times, which is rare. Right now, it sits at 1.5%. There is nothing on the timeline that shows anything close to this. So let's think about that for a minute. If you're watching this on YouTube, I'm going to bring up a chart. But you could earn 5% risk-free, right? Sleep at night, perfectly fine. But according to models, you're going to earn about 6.5% on equities, right? And you could debate that model back and forth. So is it worth to buy stocks here when you see the massive headwinds where you have higher rates coming, possible recession? Again, these are debatable, possible recession, slower job growth, inflation picking back up now. I mean, does it make sense to own? Think about the staples, right? So you own Pfizer, UPS, Kellogg, Clorox, Broadcom, Exxon, Chevron, Coke, Citi. These are companies that are, staples, not really growing that fast, but they all pay 3% yields. And a lot of people use that and say, wow, I want to earn that 3% yield. Well, why take the risk? Because that 3% yield could be worth nothing if these stocks come down 10%, right? That means you still lost money when you could earn 5% risk-free. And as an equity fund manager looking at this, I feel like at the beginning of the year, they saw this and said, okay, we're off sides, and so much money poured into the market the last month where the NASDAQ was up, 16% in 40 days, which is freaking insane. But right now, you're looking at equities being more expensive, more risky than almost any other time that's on the map. And I'm going to bring this up really quick because I'm showing this, and this is, I was able to get a picture of this. If you guys on YouTube, you could see it. And the death zone, right? It's a high risk zone is in yellow, and then there's a death zone below it. For those of you who are just listening to this on iTunes or whatever, we've been in the high risk zone, the yellow part, which is between 2% and 2.7%. A couple of times, and every time I hit that, we were okay. We've never been at these levels. I mean, you could just see we're in an area that's in uncharted territory, meaning that is it really worth it? And those are the big stocks, right? And now when you're seeing rates go higher, it should mean that a lot of the risky stuff is going to get killed even more. And that's not happening. You're seeing a lot of those stocks continue to go higher up to this week. But that report has been surfacing. They mentioned on TV a little bit. And again, this guy has been right, he's been wrong recently. But when you're looking at the details of this, it presents a very scary situation because for the first time ever, Daniel, first time since, pre-2008, where you're looking at so many of these, retirees begging for yield. I mean, this is why the housing market, this is why the housing bubble happened, right? You had all these AAA ratings and all these fake ratings that they put on, they created, these products that offered high interest AAA ratings on it. And then they offered synthetic products, and everybody trillions flooded in to earn an interest rate in a zero interest rate world. Now you can get 5% for free. It makes the investing part into equities, it's not as enticing, and you could see money flow out. And that's the danger of this market right now when you see rates going higher.
The chart, what do they say? A picture's worth 1,000 words. Mm-hmm. That makes total sense. We were talking offline, and I'm a very simple person. I hate formulas, and I was talking to you about these formulas. I was like, these things drive me nuts looking at you can just go into any search engine and look at the equity risk premium. The wild thing to me, it's tough to wrap my head around saying, okay, it's better when the equity risk premium is higher than lower, but it makes sense to say, hey, you're taking on a lot of risk to only generate 1.5% over bonds versus, like you said, in the last average is 4 to 5. This just is the picture is amazing to me, and it just shows you, hey, this is a great data point to think of a T-chart. Hey, I'm bullish, I'm bearish. What do I think of the overall market conditions when I go and add positions to my portfolio? That chart to me just screams why you should have exposure to bonds. It's just a simple thing of saying, hey, right now, just keep this in the back of your head. Things are very, very tilted to one side based on historical data. Mm-hmm. Like you've said, doesn't mean tomorrow is going to change everything and be totally different environment. Simply says, hey, the market is giving you 5% annualized, guaranteed, risk-free. Why wouldn't you take that? And I don't think there's a good argument to say that you shouldn't take that for a portion of your money. I think that's what that chart says, simplicity. And that's why charts are amazing, Frank, because reading through jargon sometimes is like terrible. But you see that chart and it's like, hey, I don't need to know everything about this. This is an extreme. I need to file this away in the whole common sense department.
And we've done this too in our industry where, we have great editors that throughout my career I've had them. And whenever you have a chart, the reason why you have a chart is because it makes it very easy to explain something. And a lot of times people use charts and it's more confusing. This is a chart that's not confusing.
Yeah, exactly.
You can see it. So for any of you out there who want to become publishers or write, you have to convey that message. And if you want a bigger audience, you got to simplify it and you have to make it simple. This chart makes it pretty simple because when you talk about equity risk premium, people are like, what are you talking about? It's just, the lower that number, the worse. We're in uncharted territories to take on that kind of risk and earn that little return, right? Because the whole world is about risk reward. That's what it's about. And that's one of the things I said, and I always highlight my mistakes. One of the things I'm most proud of is being bearish on the market, but being able to outperform in a lot of the newsletters while protecting ourselves. I mean, that's the goal, right? That's what you really want to do, right? If you could do that, if you get off protection and take on less risk, but still generate very strong returns compared to the market, that's the goal. That should always be your goal, 100%. In this, the risk reward, I mean, look at the risks that you have to take, and the reward is very, very little compared to just saying, you know what, I'm just going to throw this in there and just earn 5%. Mm-hmm. So that you need to understand that because sooner or later that matters. And if rates are going to go higher, and I don't know.
Good point. The momentum right now is that's going to go up.
Yeah. I mean, we're seeing rates pull
back. So 5 now, but it might be 5.5 or 6 in 3 months.
Yeah. I mean, we're seeing rates pull back a little bit right now. So, which is good. The 10 years like at 3.91. It was it was almost 4%. I think it was yesterday, the day before, which is crazy. But you're seeing like this back and forth, this pull and tug, and so those are the negatives.
So
right?
Be cautious.
Yeah, so be cautious. But on the positive note, and again, there's no bias here. For me, it's all about the data. It's not like, all right, I have this agenda, and oh my God, this better happen. My job is to be right, and help people make money.